You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means we are back once again for the premier options educational program. Yes, it is time once again for Options Bootcamp. My name, of course, Mark Longo from theoptionsinsider.com, as well as, of course, from the ever scintillating, ever insightful, at least we tend to think so, Options Insider Radio Network. Reminding you of a couple of things. Coming off November, just a ridiculous banger month by any stretch of the imagination. I had to go check the numbers twice to make sure they were all correct. A lot of folks piling into the network, a lot of folks piling into Options Bootcamp. So first off, welcome to all of you new listeners. We love you all. B, if you like what you hear and you're on the on-demand side, do keep rating and reviewing. It clearly does help the new folks continue to discover not just this show, but everything else we do here on the network. And then, of course, if you want to go above and beyond, you want more content in your lives, including, I don't know, nearly 200 exclusive pro shows on our exclusive pro podcast feed, including great pro Q&As, some of the best minds in the world of options and derivatives, as well as unusual activity shows, as well as great giveaways, as well as live access to this, everything else we do throughout the week, and a whole bunch more. Head on over to theoptionsinsider.com/pro, or for you cool kids, /secret club. If you'd done that, you wouldn't be waiting a week to listen to this episode right now. You'd be hearing it in your ear holes instantaneously over there. And joining me to help me break down the land of options education once again, he is the black-hatted one himself, Mr. Dan Passarelli from Market Taker Mentoring. Mr. P, welcome back to the program, sir. How go things in the land of MTM?
Well, buongiorno, Mark. Things are going very well today in the land of MTM. We're trading. We're sharing information with our student traders. We are creating greater traders, one trader at a time, Mark.
Indeed. And often those folks come from overseas as well, just like our 5-star review this week. I'm not sure which country this one is from. This comes from Aunt C, and he or she says, I've learned a ton from this show. If you trade options, then you should check it out. Well, thank you, Aunt C. Dan, a little bit more international love, which is always nice for the show. By the way, in between episodes of the show, I was doing a little bit more research for our previous international reviewer. Who is this? Cadwales, who had questions about international brokers. I did check, Dan. Options Express is available in Australia. They do have an Australian subsidiary. So that just shows how nuanced it is. OX, you can trade. IB, you can trade. TD, no thank you, sir. So, yeah, it's just the whole regulatory thing is weird. But there you go, Cadwales. 2 suggestions for you on how you can access U.S. markets. And then, Dan, what do you think about our next international viewer here, Ansi, taking some time out of his schedule to give us 5 stars?
I think that's very kind of you, Ansi. Thank you very, very much. There's nothing I like more than 5 stars, except a really good taco.
I might go for 6 stars. 6 stars out of 5, always pretty good as well. I could squeeze that in there. But I digress. As we keep on rolling, it's time for a little bit of the old options drills.
Well, in boots, time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me? Yes, sir!
All right, everybody. Welcome to the options drills. This is where we take an option strategy or concept that we've explored in the past and maybe explain some different use cases for it, or maybe how you can utilize it in different environments. The latter is exactly what we're going to do today. Going to revisit an old friend, which is the covered call. This one we touched on many times. If you want whole episodes on covered calls, listeners, again, I encourage you, if you're one of our legion of new listeners, you should be doing this anyway. Go check out the archives. There's covered calls for days in there. If you want even more, also Options Playbook Radio. We've also done full episodes on covered calls. If you want even more on top of that, Mr. Amberson, the Oracle of New Hampshire, and I have done whole episodes with a number of great guests on the Advisors Option program, detailing the best and worst ways to trade covered calls. So if you want dozens upon dozens of hours of covered call content, we have it there for you in our network archive. So that's this show, that's Options Playbook Radio, and that is the Advisors Option. If you want more in-depth into covered calls, we're just going to explain one nuance of covered calls out there today, which is their use case, or perhaps lack thereof, Dan, in the kind of market we find ourselves in now, with maybe the exception of the last couple of sessions where we have been rallying. We are recording this, listeners, as everyone's waiting on pins and needles for the next big Fed announcement. Before we even get there, Dan, I was talking about this on the network last week, really quickly, brief aside. And I was saying to someone, I think this might be the most Fed-driven market I've ever seen. Would you concur with that, sir? Do you think maybe the heady days of Greenspan, when everyone was living off the briefcase was that crazier?
I would put those latter days of Greenspan up there with this. I remember the week when Greenspan rose interest rates by 75 basis points in a week, 50 one day, 25, like a surprise. Which one was a surprise? 25 or 50? I forget. And geez Louise, you would have thought the world was ending. And I don't know, that might be recency bias for you, Mark.
It might very well be. I'm just trying to think of another time, because obviously those were heavy days. And when Greenspan would show up with his briefcase and people were measuring its thickness, that was to a degree I had never seen before. But you're right. Those were sporadic moments of intense interest in the Fed. But then we moved on to other things. It seems like since March of 2020, the Fed has been topic number one and has not gone away for 2+ years, sir. Every single thing that drives the market up or down is, how can this be backed into the next Fed decision? Would you agree with that?
Well, yeah. I mean, to be fair, yeah. Like, every bit of news that comes out is all, what is the Fed going to think of this?
Pretty much. Auto sales, how does that impact the Fed? Crypto, how does that impact the Fed? All back to the Fed, even things that are completely unrelated, you would think. Flocks of seagulls, how does that impact the Fed? All sorts of madness out there, sir. I made that point, and I was curious to see if others agree with that. If you want to do a bit of a point counterpoint, I'll see your counterpoint. I think the Greenspan era was a close number 2. I just don't think it had the duration. I don't think we were talking about Greenspan every day of the week for years, the way we are with Powell and the Fed, for not the best reasons, but nonetheless, it still is the topic. I digress, sir. We can talk Fed for hours. Let's get into the fun of this week. I know this has been a hot topic over there at MTM right now. I'm guessing probably because of just the market environment we find ourselves in, Dan, but what was it about using covered calls in bear markets, or perhaps the lack thereof, why it isn't a good use case? What was it that made you want to talk about this now?
Well, the thing is that most people, when the markets are down, kind of figure that they're going to go back up, which obviously one day they will. It could be later today. It could be a year from now. And so they get really nervous about selling covered calls because, goodness forbid. I was one time cautioned by one of our student traders for saying God forbid, and I respect that, goodness forbid, Mark, that you get assigned on a covered call. But I think a lot of people are really missing some great opportunities because of the enhanced implied volatility and missing an opportunity because they're over fearful about getting assigned on covered calls.
That has always mystified me, the fact that people freak out when they are about to be or when they are assigned on covered calls. I've said it a million times. I'm sure you have as well, Dan. When you get assigned on a covered call, you win. That's the outcome you kind of want. Maybe you don't want it to blow through it by 50 handles, but you want that outcome. That means you're making money on your underlying. You got to a price level you determined ahead of time. You were comfortable selling the underlying, and it all came to pass. You made money on pretty much both legs. You should be happy, Dan. Don't you concur?
Yeah. I mean, just from a super straightforward hand-to-hand combat, yes, you win. It is a positive delta trade. That's what you want. And we can unpack a lot more with that throughout this episode. I'm really excited to talk about this.
All right, let's get to the unpacking then. Let's do it. So we're in I guess you could say a bear market. Technically, the whole year is. The last month and change has been a little bit more challenging. We've kind of been bouncing around this 3,950 to 4,000 level in the S&P. It seems like forever now. It's really only been about a month. So we've kind of been sideways lately. But for the better part of this year, Dan, it has been mostly straight down. So in these types of environments, what are you counseling your mentees in terms of the use case? Should they be using covered calls? Should they not? Should they just be liquidating their stock instead? What approach are you advocating there?
I am advocating that on the right stocks, you should be trading covered calls on them. You should be taking advantage of this amazing opportunity. And so much so that I'm doing it. And B, a couple of weeks ago, we had a big kind of town hall webinar, like an online training complimentary, all on covered calls because it's such an important time to be doing them.
And why is that? Why is it such an important time to be doing covered calls now?
Okay, so let's get into it. I think we're all good with what a covered call is, right? You own stock, you sell a call to take in some extra premium. You might get assigned if the stock goes above the strike, right? Well, what gives options value, right? There's a number of things. Of course, if the underlying stock goes up or down, the value of that option, in this case calls, goes up or down with it, right? Time passing gives options, time, I guess I should say, gives options value. When we're selling options, time passing adds to value. But the thing that a lot of people don't think enough about is implied volatility gives options value. And when markets are jittery, when they're down, when we're in a bear market, implied volatility tends to be higher, right? We've barely been under 20 in the VIX. Geez Louise, probably this whole year, if I'm not mistaken, right? And so what that means is that options have been very expensive all year. And so that means that when you sell your calls, when you sell your covered calls, you're getting more premium for them. It's like if you're an insurance company, who do you want to insure? Do you want to insure, people who never crash their car, or do you want to insure, the 18-year-olds driving red Camaros? Well, the answer is it doesn't really matter. Neither is a bad business if your actuaries are doing their jobs correctly, right? Because you collect massively more premium insuring those high-risk drivers. And so that makes up for it. And those types of insurance companies, they still make money. They run their business in some ways exactly the same, in some ways, a little bit different, nuanced. But, that's the exact same thing here. It's not a worse trade because the stock can go up and, you miss out on that upside. Your chances of that happening I mean, they're still just as much as they were beforehand because you're able to sell farther away strikes, A, you're able to collect bigger premiums, B, and in a minute, I want to get into the adjustment process, but I'll, stop talking for a minute here and let you jump in if you have something to add there.
Yeah, there's a lot of different ways we can go with that. I'm curious for you because you mentioned adjustments, you mentioned the structure. I think for a lot of people listening to this, they'll be thinking, okay, if I know it's a bit of a bear market, I probably should structure my covered calls a little bit differently. So in that kind of scenario, maybe let's start there, Dan. How do you typically recommend people set up their covered calls differently? Do you start maybe migrating a little bit more in the money? Do you keep them out of the money? How do you tend to set up your covered calls differently in a bear market versus, let's say, a 2021 massive up year?
Not much different, to tell you the truth. And this is part of our MTM Smart Income System that I held that complimentary webinar a couple weeks ago. If anybody's interested in the replay, send me an email or join our chat room and DM me, and I'll see if I can dig up a replay from it. But, one of the things that I do a little bit differently is that I sell a little farther away from the money. I give myself a little bit extra wiggle room. Now, to be fair, that wiggle room is sometimes important, sometimes not. The most important thing that you can do when trading covered calls is, like, step one is identify your objective. Okay? Do I want to skate on the covered call and just keep the premium and then roll it and do it again? Or do I actually want to get a sign? And like this, just that can be a massive game changer to you, right? Because a lot of people don't think about it. They put on the covered call and they say, I'll be okay if I get assigned. And then it goes through the strike and they're like, oh no, I really actually wanted to skate on it. Oh geez, what do I do now? Oh man. And then, you can't manage it properly because you're making emotional decisions after the fact. Step one is to decide, do I want to skate on it or do I want to get assigned? Now, for me, honestly, most of the time, I not all the time, but I would say maybe 2/3, maybe about half the time, I do want to skate. But what if the stock goes up through the strike price? So like, let's put some numbers on this. We have good old XYZ stock that I've made billions of dollars trading. Good old XYZ stock is trading at $100. And I don't think it's going to go up above 105. Maybe there's some resistance at 105. I sell the 105 strike calls with the objective to skate. And maybe I collect $2 for those calls, right? So, I tend to keep mine 2 weeks or less. Let's just say I sell a 10-day call or something. So 5 days later, guess what? Well, the stock is trading at 106, and now my call is worth $2.50, and I'm down money on my call. Oh no, it's the end of the world. No, it's not the end of the world. I love losing money on covered calls. Why? Because the game isn't over at this point. Covered calls should only be traded as part of a system where every one covered call that you sell against the stock is just one little spoke in the wheel. Okay? So what I do, even when I want to skate or when I want to get assigned, I'll do this sometimes too, is I'll buy those calls back. I'll take my little 50-cent loss and I'll go and I'll sell maybe the same expiration 108 strike calls taking $1, or more often than not, I'll roll up to a higher strike and then out to a further expiration. Just call that rolling up and out. Maybe I'll sell the 110 strike calls for $1.75. Well, guess what happens? I end up getting back that 50 cents that I lost, And now I've got another $1.25 if I skate. And even if I don't skate, if I have to buy those back at $2 or something, I roll up and out again and I collect another $1.50 or $2 or whatever it is. And that series I make money on. It's a lot like it's a lot like a lot of things. Sort of like the well, I'm not going to use that analogy. The one thing that in our MTM Smart Income System that I try and make very clear is it's a system. Each one of those is a spoke in the wheel, and it's less about the individual option premiums. It's more about the series of how long it takes to collect a premium. In a perfect world, sell the 105, skate on them, sell the 105s again, skate on them, sell the 105s again, skate on them. But that doesn't always happen. Sometimes each cycle is 2 or 3 covered calls to end up taking in that premium. So that's a big part of what differentiates the way that we market takers think about covered calls as opposed to a typical investor.
All right, let's keep on rolling here. See if we can squeeze in a couple of questions in a little bit of time we got left. Let's get on into real quick mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody, welcome to the mail call. Really quickly, before we get there, Dan, I know you always are busy interacting with your mentees. Sounds like you're interacting with them a lot right now about covered calls. But outside of that, is there anything that is really percolating that is top of mind that is your MTM patented question of the week, sir?
Well, around this time of year, Mark, people are asking me, hey, what are some strategies that you think are going to work in 2023? And the broadest answer, I always like to start with a broad answer. The broadest answer is that I believe that the volatility regime that we are in, which I'll basically define as a VIX over 20, right, which is what it was for almost all of 2022, that's here to stay for all of 2023. I think it's going to be few and far between that the VIX is going to end up being below 20, and when it is, there's going to be your option buying opportunities because it's going to go right back up. So some strategies that can work: straddles when you're careful. I said you go back to the December of last year episodes or the January of this year episodes. I said this year is going to be the year of the straddle, and it was. And next year, 2023, is as well. And also, and that's when you can find good straddles. We've said many times on the show, they're tricky to trade, they're tricky to find, but when you can find them, they're going to be great. But then volatility selling opportunities too, when volatility gets towards the high end of the spectrum, which is when everybody's very scared to sell volatility, but they can be some of the best times to do so.
Should have made straddles your trade of the year from our last episode, sir. There you go. You're all about the straddles. Mr. Dan, yeah. Loving yourself some straddles. Speaking along those lines of looking ahead to next year, you have this question here from Pal Juarez. He wants to know, what do you guys think will happen to the options market next year? Is the options explosion finally going to come to an end? Well, Paul Harris, this has been a talking point for the last couple of years, ever since the big madness of March 2020 really sent the markets into a tailspin and the options markets into this volume explosion that no one could have ever predicted. I tried to fade it last year. I didn't think it was really going to continue. And then sure enough, the meme stock palooza came along and everyone and their mother was trading even more options. We got close to 10 billion contracts last year. This year, we seem pretty much on pace to beat 10 billion contracts. Thanks in no small part to the zero DTE explosion going on out there in the S. But yeah, it's crazy town. So I've stopped, Paul Harris. Long answer or short answer really is I've stopped second guessing this market. It does seem like we've had a structural shift in the options market where there are just more people trading these things now than there were a couple of years ago. In the past, we'd see these spurts, not to this degree, but we would see spurts after big events. People would come in and they would usually roll off and move on to some other product. Maybe they would lose money, not have a good experience. They would listen to some guru online. They would lose all their money and they would never trade options again. These days, it seems like people have learned, maybe not just listening to this show, obviously, coming in from all different areas. There are many great sources of quality education out there, not just the least of which should be your broker out there providing you with great free education to teach you how to keep that money in your account and grow it. So people are staying around longer. They're trading these things longer. So as a result, I think we are in a different structural paradigm from an options perspective. Again, November, not usually a rock'em sock'em month. 922 million contracts we put up last month. The ADV is now 41.3 million contracts. That is volume per day, listeners. That is more than, anyone would have considered just a few years ago. ETF options up 43% in November compared to a year ago. Index options, so your SPXs, that gets to that zero DTE stuff, up nearly 50% year over year. So it's crazy town, but it's about any metric you can throw at this thing. So I don't think, even if, let's say, we have another protracted bear market, people thought the bear market this year was going to kill this thing. It did not. So we can have another horrible down year, horrible recession. Folks are still out there trading options. I wouldn't be surprised if we still see, at the very least, maybe even levels around what we're seeing right now, if not more. Dan, what are your thoughts on this time next year? You think the options explosion can continue, sir?
Yeah, I would say that with a 90% confidence interval. I believe it will definitely continue to explode because it took 50 years, but people finally caught on to what options can do for them. It used to be that, people as traders and investors have gotten massively more sophisticated certainly over the past 50 years, but even over the past 15 years. It used to be that people would just use options as a leverage substitute for the stock. Buying calls was the most popular strategy. Covered calls second because it's just, so simple. There's some nuance to it, but, a little bit simple if you put in the effort to learn it. But, now people who come to me aren't coming to me knowing nothing and asking which strike is the best one to buy when I buy my calls. They're very nuanced questions. People already understand how to use options, not just to provide leverage and not just to generate income, which, 15 years ago, that was sophisticated. Now they're using them to protect themselves. People used to run away from options when it was a bear market because, goodness, I can't buy calls in a bear market. But people now know that, hey, man, I'm typically not going to buy calls anyway. I'm going to do something smarter, spread it or forget it. So, yeah, just the level of sophistication that people have, this thing has legs. The options market is going to just continue to grow and grow and grow.
You got time to do one more about all this zero DTE madness?
Let's do it.
Let's do it. All right. We've been teasing it for the last couple episodes. Let's get to it now. This question comes from Danny B. Danny B says, I've heard Mark and guests talking about, quote, zero DTE options on the network recently. I think I understand what he's talking about, but can you guys clarify this stuff on OBC? What exactly is zero DTE trading, and is it really becoming that popular? How should we approach this? All sorts of great questions baked into there, Danny. Maybe that could be a future episode of Options Bootcamp in and of itself. Let's start with the basic definition. Zero DTE. This is also known as expiration day trading, aka the stuff Dan and I used to do once a month back on the floor as a market maker, because there was only one expiration day every month. That was it. And there were a handful of guys. I usually tried to avoid doing a lot of stuff on these days because your systems back then couldn't really chart your exponentially exploding gamma and theta. And it was more of a hassle to have positions on, so you try to close them out. But there were a handful of people out there. You'd only see them once a month on expiration day because that was the day where they could come in. They could try to trade in and around things. They knew their synthetics. They knew their basic levels. Or if you buy a call, this much premium, what is your break even? What is it underwater? You try to scoop things underwater levels and lock in some actual profits. You can do it, but you have to be quick on the trigger finger, and it is somewhat risky. So zero DTE is that just writ large. That is 0 days to expiration. What that stands for it means the thing you're trading expires that day. And why is this so popular now? It's funny because we had daily quote unquote expirations in the SPX for a long time. It just didn't have the full week until a few months ago. And then they added the last couple of days that they were missing. And then now all of a sudden you had an expiration popping off every day of the week in the SPX. And it's like a light bulb went off out there. The product, which is one of the most entrenched institutional products in the options market by a country mile, has now just shifted almost overnight into a very different beast. I'm looking at it right now, and the top 20 contracts in the SPX for today, I'm sure it's well over 1 million contracts. The top 20 most actives right now, I only see one that is not expiring today. So 19 of the top 20 trades, contracts, whatever, in SPX today are all zero DT. They are all going out today. And that just shows you how incredibly popular this stuff is. Now, it's still limited for the most part to the SPX. You can't do this, let's say, in an Apple or a Tesla yet. And I say yet. I have put this to the CEO of OCC not that long ago, back at the Options Industry Conference earlier this year, saying, hey, people are liking these shorter duration contracts in the SPX. Any chance we're going to see this stuff start happening in the single names? And he was a little bit reluctant for a variety of reasons. You have a lot of things that could happen in a single name, like a Tesla or an Apple, that can't happen in the index. You're not going to have a corporate action, a takeover, a surprise dividend, earnings, whatever the case may be. All these crazy things that could happen in a single name. And so to have that risk on top of modeling and expiration every day, I'm not sure if OCC is quite down for that yet, if the tech is ready for it yet. But in the S, where you don't have those types of corporate actions, you can get away with it. And so I think we will start seeing this in more index products going forward. But is it really that popular? I mean, 19 of the top 20 SPX. This is the SPX. This is a big product. 19 of the top 20 trades are that now. That means funds are doing it and retail are doing it. It's kind of changed the game. Dan, what are your thoughts on this? Are you as surprised as I am that it just took off with such force? I mean, we had quasi-dailies in the SPX for a long time. They were just missing the other two. And apparently that was the missing piece of the puzzle, Dan, because now it's just off to the races. What are your thoughts for Danny B here? He wants to know about zero DT, what it is it really that popular, and how should we approach it?
I am a bit surprised on it. And actually, I think that the timeline, just the chronology that you talked about, I'd never really thought of before how, listing the weeklies, the light bulb went off for a lot of people, and that just evolved it into 3 times a week into dailies. So yeah, it's been interesting how we got there. And I think you're exactly right. That is how we got there. And man, it really presents some opportunity for clever traders, and the gamblers too, but especially the clever traders who do edge-based zero DTE stuff.
Let's talk about that really quickly then. What is your edge-based approach? I think this is going to be a subject for future episodes of Boot Camp too. We can't ignore it. It's just the elephant in the room right now. Right now, what is your use case for zero DTE options, sir?
Well, yeah, it would have to be a whole big episode, but basically I look for certain thresholds and certain benchmarks, and sell only when I believe that I have a statistical advantage, and so not just guessing, but and not just, hey, every morning I'd sell the iron condor or the put spread. There are certain triggers that happen, and if they trigger, I trade a certain thing, and if they don't, then I don't trade that certain thing. And I know I'm being a little bit vague, but we're kind of towards the end of the show here, and I'm going to save that ace up my sleeve for when we do an episode on this.
We will indeed come back to this, Danny. So yes, this is just kind of our taster, our amuse-bouche for the deeper meal that is to come, Dan. That is all things zero DTE. But the use cases for these is all over the place. I was talking to the Greasy Meatball the other day. He loves it just for the fact that he has no residual positions at the end of the day, which for an old school market maker is kind of refreshing. So that takes that worry out of your hands. That's probably why a lot of funds maybe are doing this. People are doing straight up long calls, long puts, and even multi-legs. A lot of people hit me up saying, hey, zero DTE butterflies are the new hotness out there. And traditionally I would have laughed at you and said, that's absurd. Butterflies on the day of expiration, it's kind of the last day you want to do them. But the way these things are rolling out, might be some opportunity there. So I think we need to revisit all the ways we look at expiration in light of these new products. So great question, Danny B. I think to the last part of your question, how should we approach this? I think we're going to have more episodes coming. So stay tuned, listeners. At Zero DTE, we're just on the cusp of this new trend. And again, we talked about the last question about transforming the options market going forward. I think if this trend proliferates, and there's every sign that it will, this could be another transformative thing that really brings a whole bunch of new paper to the options market. Think about it. You're trading once a week before. Now you're trading every day. You have daily expirations. That's 5x your contracts in a lot of these products out here. What it cannibalizes, how this impacts how options perform. Remember, the last time we saw a big shift like this was the move from monthlies to weeklies. And that had a lot of impacts on how the monthlies perform because so much paper was being cannibalized and siphoned off into the weeklies. The monthlies started performing different. So it'll be interesting to see now that we have this proliferation of dailies, what unintended consequences are there as a result of all this paper moving from not just a monthly to a weekly, but now from a weekly to a daily? How does that impact the weekly? How does that impact the monthly? How does it impact the other dailies? There are questions still out there about how all this will shake out. Going to be some interesting academic research, I'm sure, and a lot of practical analysis of the markets as well to come. So, yeah, this is just the beginning of this conversation we're having here on all things zero DTE. And Dan, while they're waiting for our next episode on all things zero DTE, Dan, if they have questions about this or anything else, where should they go? What should they do?
Well, make your way on over to markettaker.com and we'll get all your questions answered that we don't answer on this show. I'm glad to help you out after hours, if you will.
There we go. It's going to do it for another fun episode of Options Bootcamp. Remember, if you want to get access to all of the great premium podcast episodes we do over there, as well as the giveaways, as well as the live, all the other fun, head on over to theoptionsinsider.com/pro. That's the place to go. Or for you cool cats listening to Bootcamp/Secret Club, that's going to do it for us this week. Back again next Education Wednesday, another episode of Options Bootcamp. Stay safe out there, everybody.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.